All right, well, welcome back today. My name is John Mazzara, Remax Results. I have a special guest today, Ivan Oberon with Edge Home Finance and his company, Your Kingdom Lender. Today, we're going to talk about a really interesting loan called the DSCR programs, the debt service coverage ratio programs, as well as other investor cash flow products. One of the most difficult things as an investor is to continue to buy properties, especially if you're self-employed or if you hit the 10 property rule limit for, I think it's for, is it Freddie or Fannie that runs that one?
Fanny.
Fannie. Okay. So when you want to keep growing and you're trying to figure it out, there is a product out there that can help you continue to build your portfolio. And Ivan is going to talk all about it. So Ivan,
Yeah.
let us know what's going on.
Thanks, everybody. Yeah, Ivan here, your Kingdom lender, and working with investors and being a resource to them has been a passion of mine since the beginning of my career because that's how I started. I started raising capital. I wanted to learn how to flip homes and buy real estate and do all that sort of thing. So I figured I like dealing with people and working with investors and helping them with their money and get better rates of return and all that kind of stuff. So I started doing it for myself and became pretty good at that. I had more money than I had personal deals. So that's kind of how I fell into lending. I started doing debt equity with my investors' money with other people doing fix and flip loans and turn into spec home developments. And I've flipped 52 homes
Wow.
across 3 different states
Wow.
and I've done everything from finance your typical basic stuff in the Midwest and in Kansas City, Missouri, where we bought it for 25,000, put 20 into it, and sold it for 65 or 80, all the way up to spec homes here in Beverly Hills and Bel Air, Brentwood that have sold for over $9 million.
Wow.
So being on that side of the desk gives me I think a unique perspective to really help my investors, especially some of the ones that are first starting out. Make sure first and foremost that they do have a viable deal, that they have something that they have that they can stand to make some money on. And then of course with the debt service coverage ratio, it's I think one of the best things to ever happen to investors because even if you can qualify for an investment property purchase through a conventional or FHA loan, the qualifying parameters are so much easier, and you also like you were saying, you don't have the limit as to how you can scale your portfolio over time. And nowadays, believe it or not, even though the conventional or more traditional qualifying guidelines, the full income qualifying guidelines, the rate might be slightly better on that program. You'd be surprised to find out that it comes at a much higher cost. So for me, the debt service coverage ratio program is the best thing out there for investors looking to grow their portfolio. And well, what does that mean? What is that exactly? Well, just think of it as DTI for the house, right? Your debt to income for the house is the debt service, which is defined as your principal, your interest, your taxes, and your insurance. Now, of course, we know we have other expenses, but they don't look at any of those other expenses. It's just your principal, your interest, your taxes, and insurance. And if you're unfortunate enough to have an HOA, right? So all those play into that debt service coverage ratio. And what we're looking for is a 1-to-1 ratio or 100% debt service coverage ratio, meaning if your debt service is $1,500 a month and your rent is $1,500 a month, you meet that threshold, right? So you can essentially that's the baseline for qualifying. It has nothing to do with your income. It has nothing to do with your employment. Now, your credit does play a role, right? Because you do have to have minimum credit scores for qualifying. And the better your credit, the better the rate that you're going to qualify for, just like any other loan. But other than that, they don't really look at anything else other than what does the asset look like? How will it perform? And then you qualify. So that's pretty neat. The other cool thing is that as you get better DTI for the house, if you have better cash flow, as you start creeping into 110 or 110% or 120%, 150% debt service coverage ratio, you do receive certain pricing breaks. So you would be able to get little rate reductions the better the cash flow. right? Because again, like I've said before, everything is dependent on what's the risk profile to the investor, and they figure the greater the net positive cash flow, the more secure that investment is. Because if something were to happen to you as the borrower, the owner, well, the property will carry itself, and they're going to get paid, right? Now, some investors, they'll do refinances or even purchases strategically. Maybe they want a tax write-off. Maybe it doesn't debt service. Maybe it doesn't hit that 1.0 or 100% debt service coverage ratio. Maybe it only gets to 75 or zero point 0.6 or zero point 0.5. And for whatever reason, you make a business decision that you're okay taking this loan that you know is going to receive negative cash flow and you're going to have to come out of pocket to cover it. I've done this many times. I'm not saying it's a sound investment strategy, but I've done it many times because an investor was in a position where they knew, okay, if I take cash out of this property or if I add this property to my portfolio, I have a strategy to use that cash to make me way more money than this loss that I'm taking. And by the way, that loss is also a tax write-off, so I'm going to get a benefit there. And I have the strategy to cover this and to carry it throughout the year with no problem. Whatever it is, the point is, if you have a property like that and it makes sense and you need it, we can go what's called a no ratio loan for qualifying also. Now, of course, you can expect a higher rate than you would if you were a 110% coverage ratio. But the point being, you can get it done and it's better than not being able to do it at all. So those are the basics of the program, who it's good for, and kind of how it works.
Well, what if the home is vacant, so I don't have a lease in place? Or what if the tenant isn't paying right now, and I'm gonna obviously get them out, but what if they're not paying at the moment, then what?
So that's a great question, because we do run into that quite a bit on purchases. Some of my clients will buy a house and we'll do a bridge loan to do maybe some rehab work, and then we'll refinance them out into that long-term 30-year product. But there's often a gap between, okay, when we're ready to do that and when there's a tenant in place, or they're buying a property and then it just happens to be between tenants. Every single one of these loans, regardless of whether they're occupied or not, with a lease agreement or not, are going to receive or be required to do what's called a 1004. I'm sorry, 1007 on the appraisal, which is basically just a fancy code for a market rental survey. So whatever that market rental survey says, let's just say it says $1,500 a month for this 2-bedroom, 3-bath, 1,500 square foot home. That's the going market rate. The debt service coverage ratio for qualifying will be calculated based off of the market rental survey on the appraisal.
So regardless of the lease, so if the lease says 2,500 and the rental survey says 1,800, we're gonna go off of 1,800.
Generally speaking, yes. The only time where we can fight that is, say, okay, the lease says 25, market rental says 1,800, but wait, here's my lease, and here's at least 2 months of payments at 2,500 to justify the higher amount. And then we can get the qualifying number bumped up to the 25 versus the 18. Where
Oh,
that
okay.
becomes more of a challenge is, say, man, I just got this lease today. We're trying to close this loan tomorrow. Market rental says 18, lease says 25. There's no real proof of that. So what we can sometimes do for an exception is, okay, well, but have they put down their deposit and their first month payment yet? And as long as that's happened, oftentimes we can get an exception to go that way as well. But if it's vacant and we don't have anything, and there isn't money, in exchange of that valuable consideration, that new income, then we're going to be subject to whatever the appraisal says.
Okay. So where this could really be useful, if somebody has their Schedule E and can prove, or leases that, yes, I really have been getting 2,500 or whatever the amount is, that could be documented proof.
Yes. Yes, but we would never use a Schedule E, because we would just use the lease, because we
Just use
don't
lease. Okay.
we don't want to be talking about tax returns on this, or W-2s,
Okay.
or rent skit. None of that kind of stuff. It's just show me the lease and show me the deposit.
Oh, very nice. I like that even better. Easy
Hmm.
peasy.
Hmm.
And if I understand it right too, you're going to go and going down to 100% is amazing. A lot of lenders out there require the 125 or the 150. And so I've not heard of the 1.0. So that's
Yeah,
right there.
1.0 is where all my investors base pricing starts,
Wow.
right? So you can get a little bit better, and which by the way, it's competitive because I work with about 30 lenders now that offer this program because everybody, now all of a sudden is starting to pick up on it. And
Hmm.
I need to make sure, how do I provide the best value to my clients? What's the best option? And make sure that they have the best pricing out there in the industry. And also know, same thing, there's different nuances that come up.
Yeah.
Okay, maybe there is an HOA and they're not warrantable. Maybe you rehab the property and you decided just to see where the value could be and you listed it for sale while you're trying to get it leased up and now you want a loan. Some lenders really frown upon that because these programs are supposed to be long-term programs. The lender doesn't want you paying off your loan super early. So some people shoot themselves in the foot really bad with certain lenders because some of them will have a 6-month seasoning requirement from the point you cancel the listing to when they'll give you a loan, which is
Hmm.
crazy, right? So we need to know that. We need to understand because again, like every other situation, especially with investors and builders, every situation is unique, and there's different things that we need to know and be able to pivot to a different lender if. Okay, well, there's this thing, and the loan won't work, even if the rate's better. It won't work because of this guideline. Now we shift over here and get it done anyway.
Cool. And this one too, a seller could carry back their equity. I mean, and down to that 100%, couldn't they? I mean, if somebody found a seller that wanted to do a carryback and essentially get 100% financing, um, that could be done, couldn't it, with one of these loans?
No.
No.
No,
Okay.
it's a great strategy, but the investors for these loans require you to have skin in the game.
Okay.
Meaning if like on conventional, or for FHA, they require 25% down, sometimes more. Well, in this, you're gonna at very best, there's one or two investors that will go all the way to 85 LTV on a purchase or 15% down. But really middle of the road for best starting price is going to be 20% down. And these investors generally will not allow for subordinate financing, right? And by way of a seller carry or something, because they
Mhm.
will source where that money is coming from,
Okay.
uh, unlike with the builder product, right? But it still can't come from a partner, right? Because these are still business purpose loans. So if you have an LLC, you have different people on the LLC, and the silent partner, let's just say, is the one
Mhm.
bringing the money to contribute to the thing. No problem. It doesn't have to be from the actual main sponsor. It could just be like, all right, well, I have an investor and I added him to the LLC because the LLC, ownership in the LLC is a much more secure way than trying to hold a second lien position that can be foreclosed upon. Now you have an actual equity position in the entity that owns the property, which is, in my opinion, a much safer way to go anyway.
Hmm.
But to your point, no, you can do an unrecorded note if you want, but either way, the money has to somehow come through the borrowing
The borrowing
entity
entity. Okay.
or the sponsorships.
Well,
Gift funds are fine. Quote unquote carrybacks are fine as long as the money still kind of comes through because they really won't source the capital on the bank statement. The, but they do want to see that it's coming from somebody that's part of the borrowing entity.
okay. And one interesting thing you mentioned was entity. So one of the big problems if somebody wanted to use Fannie Freddie, well, I know Fannie now made the change, but um, you had to have done it in the name of an individual instead of an
Correct.
entity.
Correct.
Whereas here, people ask me all the time, well, John, I have an LLC, or should I create an LLC and borrow money and, buy my property that way? And we say, well, if you're going to use, regular, other than that recent change in Fannie, you're not going to be able to do that. But
Right.
here you're actually preferring it, or at least you allow for it. Do you charge
No,
any extra pricing between?
no, that's absolutely right. I get asked, can I? And the answer is it's encouraged and preferred. Okay, there
Hmm.
there are some investors that will not give an option for you to do it in your personal name. Okay, so
Okay.
it's absolutely encouraged, it's absolutely preferred. There's no change in pricing whatsoever because there are some that will allow personal names,
Hmm.
but there's others that won't. So that tells you that it's definitely the way to go. It's encouraged and it's a good business practice.
Awesome. So somebody could take a free and clear property, refinance it at, to get to that 100%, debt coverage ratio, pull that cash out, use that cash on a down payment and on another DSCR loan and just keep
100,
keep going.
100%. And I have a lot of clients that do just that.
Yeah.
Yep. I
Wow.
have I have one that he knows his numbers. He owns about 28 properties now, and he knows usually he's actually kind of a vertically integrated investor. He's a contractor. He builds, so he finds lots, subdivides them. We give him the construction money. He refinances them out, and then keeps them all in his portfolio. He doesn't sell anything.
Hmm.
And so, but he has a specific metric that he wants to hit at least 120 to 130 on that debt service coverage ratio. That's what gives him the rate of return that he likes.
Sure.
And in many cases, there's plenty of equity in there. So sometimes I rarely see him go above like a 60% LTV, which makes his pricing great.
Sure. Wow. Another unique thing. So if somebody wants to buy rental real estate and has good credit, and has the ability to put some money down, say 15% as a minimum, this property or this could be a great way to go. So this would be great for the BRR strategy, the buy, build, and refinance and hold it.
As
And so,
long as you don't intend to occupy it as your primary residence. Okay, that's
yep.
where a lot of people would get the burst strategy and they intend to occupy it as their primary residence. You
Mhm.
cannot say under this program, you cannot say that your intent is to occupy it as your primary residence. This is investment purposes only.
Mhm.
So it's not to say that sometimes people, especially, I have a client that lives here and he does all his rentals in Tennessee and he's
Hmm.
very active. So he flies out there. Actually, he drove his motorhome out there now. And it's not to say that you don't, some people might sleep there for 2, 3, 4, 5 weeks while they're doing the rehab, but they have an alternate location that is technically their primary residence. And then that's fine.
Okay. Wow. Another great product, Ivan.
Thank you.
Well, wonderful. Well, Ivan's information will be down below this video. If you'd like to reach out to him to discuss how you can grow your portfolio, obviously he knows what he's doing and he will help you. And give him a call. So thank you for visiting today, Ivan, and
Thank you,
thank you for
John.
watching.
Always a pleasure.
Okay.